Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest and one of my favorite guests. He is a former global macro hedge fund manager managing billions of dollars in assets under management. He was active during the technology bubble, so we're going to get his insights into the risk on behavior here with Bitcoin and some of the small caps that are starting to rally, the meme stocks that are starting to rally like crazy. He also writes a paid investment research newsletter called the Felder Report. Jesse Felder, thank you for joining me again.
Always good to be with you, Jason. Thanks for having me.
And Jesse, we're recording this interview on Thursday, December 5th, 2024. The S&P 500, the general stock market indexes, they're at or near an all-time high right now. I think the S&P 500 is well over 6,000. There's people predicting it'll keep going higher now with Trump and the potential tax cuts. I want to get your thoughts, though, on a historical perspective. Are we at or near an all-time high for stock market valuations with up there with the 2000 tech bubble that you were active in and 1929 prior to the Black Tuesday, October 1929 crash?
Yeah, I think in terms of valuations, the most valuable long-term measures of equity valuations, things like the Buffett yardstick, which is just market cap to GDP, or the CAPE ratio, or something like John Hussman's price to normalized, earnings normalized for profit margins. Those types of things all point at us at being at either all-time record highs or very close to it. I think, the Buffett yardstick definitely suggests, the U.S. stock market is now more than twice the value of the total economy. Well over 200% of GDP, whereas, at the top of the dot-com bubble, it was only about 150% of GDP, and that was considered the, extreme bubble level. Well, if 150 was extreme, we're at 200% today. Another one would be something like Tobin's Q, the Q ratio, which is price to, instead of like a price to sales, Tobin's Q is more like price to asset, the value of underlying assets of these companies. And that's also at a record high. So, valuations suggest that stock market has never been more highly valued than it is today. Go back to the 1929 peak. And even then, we didn't kind of get near where we are today. Now, it's important to also point out, though, that valuation is not a timing tool.
Oh,
It's
yeah.
probably best used to understand what do, long-term returns for investors look like. But Warren Buffett has said the price you pay determines your rate of return. You pay a high price, you get a low rate of return. So investors are paying the highest prices essentially in history today. So returns going forward are likely to be on the low side.
Now, when you're trading the technology bubble, was there a lot of foreign capital from Europe and emerging markets and China and Japan? Was it coming? So this is like pension fund money, institutional investors. Was that capital flow flowing into like tech stocks similar to now? Do you see a lot of the similarities with flight capital coming in from other countries where maybe the global economy is already in a recession or depression, and they're looking at how profitable our tech companies are and the capital's coming here?
I didn't see a ton of it back then. I think the 25 years later, the world and the economy, global economy, everything is a lot more, globalized, and it's a lot easier for people to invest, overseas investors to put money to work here in the US. And I think, Ruchir Sharma had a great piece in the Financial Times this week on this very point, that probably more than ever before in history, foreign investors are massively overexposed to the U.S. stock market. I mean, it's whether it's Japanese investors, Chinese investors. I think we've talked about before in the past, Jason, that Chinese investors have been desperate to invest in the Magnificent Seven, and they've been willing to pay significant premiums to even the prices we as U.S. investors are currently paying. I think you have Korean investors as well that have been very eager to invest. In his piece for the FT, he points out that he was recently at a Singapore investment conference, and the host asked if anybody in the room didn't own NVIDIA stock, and not a single hand went up at the entire conference. So it just
Isn't that
tells you
career
that,
risk?
yeah, everybody around the world feels a real, FOMO regarding, these big tech stocks and the U.S. stock market in general.
So you manage money for our listeners out there. You're a hedge fund manager. Is there career risk then if Nvidia keeps outperforming, the Mag 7 keeps outperforming, Bitcoin, uranium, some of these big headline industries that are outperforming? If you're a fund manager and you don't have exposure to this, are you looking at potentially either having massive amounts of withdrawals like exit liquidity, or are you going to lose fund management then?
Yeah, I think that's absolutely the case. I mean, it really depends on your mandate. If you're, equity focused fund and you're basically competing against passive investments, right? And now the top 10 components of the index make up a greater share of the index than they ever have in history. We have the most highly concentrated index in history. That means, and you have to, if you're not that highly concentrated, then you're making a big bet essentially against the index. And so I think, for traditional equity managers, they're looking at, okay, a neutral position for me is essentially, equal weight, these names, NVIDIA, Microsoft, Apple, et cetera, equal weight to the index. And, the way to outperform has been, to be overweight these things. And I think this is one reason why momentum investing has been so strong this year, is we've had huge flows into passive funds, record flows into passive funds this year. Most of that money goes into obviously the biggest stocks in the index, pushes those names higher. I mean, it's amazing to me that Apple's numbers have, slowed dramatically, and it trades at the highest valuation in its history, 40 times earnings for Apple. And people are wondering why Buffett's selling. Well, you're paying a 40 PE for a company that, is likely going to grow maybe single digits, growth going forward. It makes zero sense. But with all that money flowing into passive and flowing into Apple shares and flowing into Nvidia, and then the FOMO that retail investors and institutional investors alike feel to match or better the performance of the index. Okay, well, I got to buy even more Nvidia than the is in the S&P 500 or the Nasdaq 100. I got to buy more Apple, and so we've had a huge move for momentum. And the thing that I worry about right now is typically when momentum leads the market, you get a pretty serious hangover over the following 12-month period. So we've seen one of the best 12-month periods for the momentum factor, over the last year, and that suggests to me that we're at risk of a pretty severe hangover once this momentum starts to peter out, and it looks like it's possibly doing that right now.
And if I could add to your points, isn't the US stock market indexes like the market cap weighting, isn't it over 50% of global market cap now is solely for the US stocks? And then, like you said, it's concentrated just into what, 10 technology companies. So basically, then in terms of like global market cap, you look at the European stock market, Japan, China, the US has like a very high disproportionate rating of market cap now compared to any other time in the history.
Absolutely right. And that was the point that Sharma was making in his FT piece this week, was that, the weighting of US equity markets in a global equity portfolio is the highest it's ever been. And it's this idea that, the greatness of America, which, the US economy has outperformed, most developed economies over the last few years. And obviously, these companies have done phenomenally well and massively profitable. But to take that ownership, that concentration in terms of the global portfolio to such an extreme is and the outperformance also is usually not something that's sustainable on either count. The extreme concentration in one market. I mean, we saw it. I think most famously, the time we saw it was, back in the late 80s into 1990, when Japan became such a huge component of global markets, and everybody thought Japan was going to take over the world. And what did the Japanese stock market do after 1990? It went nowhere for over, for roughly 30 years. And so, it's just typically not sustainable to see one market come to dominate in such an extreme way. And to be sure, the U.S. market is a much bigger component than Japan ever was in the global, stock market. But also, like I said, in the very short term, the outperformance of U.S. equities over the rest of the world is usually something that doesn't persist very long either. That they're all usually kind of trend in the general direction, and there is reversion to the mean. And so the significant outperformance of U.S. equities is kind of like that outperformance of the momentum factor suggests there could be a hangover in the next year.
Yeah, I would also add that there's macro factors too, that it seems that the global economy is already in a recession or depression. There's a lot of slowdown, a lot of evidence of this. You have central banks in an interest rate cutting cycle, and a lot of the liquidity ends up here, kind of like the mini dollar milkshake, if you will. Not maybe not a full dollar milkshake because the dollar index hasn't had a rip your face off rally, and yields are already starting to rise because under that scenario, Brent Johnson has said that the bond yields would actually start to fall, and we haven't seen that yet.
Yeah, I'm not a believer of the, in the dollar milkshake theory. Actually, I think I wrote a report last weekend that I think the dollar is going to be maybe the critical, chart to watch over the next several months, because I think that we're potentially in a time when the dollar is going to be, peaking and rolling over. I mean, you just look at a number of things. Look at the valuation of the dollar relative to other currencies, however you want to look at it. I typically like to use purchasing power parity, which is, basically just how much, purchasing power does it have? And the dollar is extremely overvalued relative to other currencies on this measure. It has a very good, it's kind of like the valuation of the stock market, it has a very good predictor of the direction of the currency over the next 10 years. And so the extreme overvaluation of the currency is really nothing like we've seen since the very early 2000s, since the dot-com bubble. That was the last time the dollar was this overvalued. And what did the dollar do from 2000 to 2012? It had a decade-long bear market. And dollar became very cheap, undervalued in that 2012 timeframe, and that sets the stage for the dollar bull market that we've seen over the last decade. So I think we're very likely in the going to see a dollar bear market over the next decade. And that also, fits well with the trend in the fiscal deficit, right? I mean, typically the dollar, the reason the dollar got so overvalued back in 2000 and 2002 was the fiscal deficit disappeared. We actually had a small fiscal surplus in the late 90s. A lot of that was driven by, capital gains taxes that did really well during the dot-com bubble. But the reversal in that, the fiscal deficit from a surplus to a widening deficit, obviously that exploded during the great financial crisis, was one of the driving factors of the dollar bear market. So I think we've seen the top, I guess, for the reversion in the fiscal deficit, right? It widened, it blew out during the pandemic. We 15-20% of GDP almost. And in 2022, 23, it kind of reverted back when the economy opened up and taxes improved and all these things. But really, since early 23, the deficit has started to trend wider again. And even the most benign forecasts expect it to kind of trend wider in the years ahead, which would be a bearish factor for the dollar. So I think we're likely seeing a topping process, a longer term topping process in the dollar. And that has important implications for all different types of prices of assets.
And then add to that with the stock market valuations, are we at 36 times price to sales ratio for the S&P 500? So makes sense why Warren Buffett would want to sell companies like Apple, selling at a high valuation. Bank of America, he's offloaded a record amount of shares the last 6 to 8 months. And then I think he's totally out of companies like US Bancorp and Wells Fargo over the last couple of years as well. He just doesn't want exposure to the banking system, it seems, based on a lot of his capital allocation.
I think, based on his capital allocation, I think there are two things that I would infer from it. One is he has the highest cash to assets ratio he's ever had in history. So he's never had cash as a percentage of his portfolio as big as it is today. Today, that tells me that he wants to take at least amount of exposure to risk assets as possible. I want to have as much dry powder as possible to take advantage of opportunities that might arise. I think the other thing that maybe we've talked about this in the past, but this is a huge change from what he's done. So during the dot-com bubble, he built up a cash position. He did it again in 2005-06 in the lead up to the great financial crisis. But back in the late 90s, And rather than buying treasury bills, very short-term, 3-month, 6-month bills, he was buying long-term zero coupon bonds, which is essentially a big bet on lower interest rates, on interest rates coming down. And so he basically, predicted that Greenspan was going to lower rates to 1%. That, in the dot-com bust, he was going to make a lot of money on those long-term bonds. The fact that he's doing the opposite today tells me he wants nothing to do with the long end of the yield curve. And I think that's maybe also why he's staying away from banking stocks. Is the banking stocks generally have become traded to the very high end of their longer term valuation range, like not quite as extreme as what we've seen in Apple's stock price, but a lot of bank stocks have just gotten very expensive. In the same token, if the long end of the yield curve is where kind of the risk is of interest rates, going up and getting kind of a Liz Truss type of moment here in the U.S., that could be a problem for the banking system. That's, especially regional banks that are obviously highly leveraged to longer term interest rates.
Now, this record amount of insider selling by senior executives in S&P 500 companies, is it banking system? Is it senior executives of banks, or are they kind of spread throughout with different industries?
I haven't really seen it too much in the banks, to be honest. I mean, when you see the big sales, it's typically from these Magnificent Seven companies. I mean, so Jeff Bezos has sold several $billion this year. He's a very good timer, right, of his sales. The last time he sold, actually think he sold about $13 billion worth of stock this year. And the last time he sold, I think 8 or 9 billion was in 2021 in the lead up to the 22 bear market. So Bezos, has a really good track record with his sales and has sold a ton. Obviously, insiders at NVIDIA have sold over $1 billion worth of stock this year. Jensen Huang has sold more shares than he's ever sold in history, 30-year history of running the company. I think the one that I'm noticing most recently is Palantir. We've seen a boatload of selling by insiders at Palantir. So it's a lot of these kind of tech stocks that have really benefited from the boom in the stock market over the last couple of years. Is kind of where the selling is concentrated.
So I actually wanted to ask you about these large tech companies because it seems that we're into the next tech capex capital expenditure cycle where these tech companies are committed to investing tens of billions of dollars every 3 to 4 months. That's been going on the last 18 months with Amazon, Google, Microsoft, Meta, that they've just been investing insane amounts of capital expenditure into artificial intelligence software, building out infrastructure, buying land to build data centers. Do you see this continuing in the data with the quarterly reports, or are these companies going to start cutting back because they're not getting justifiable return on investment for that capital yet?
Well, I think that is a valid open question, right? They've committed to growing their capex, and estimates are that that's going to continue to grow, but it's slowing dramatically, right? Instead of growing capex 100% year over year, I think next year, it's dropping to 20%, and the year after is expected to drop to single digits. But you bring up a really good point that even like all of these companies have come out recently. Sundar Pichai was the latest, the head of Alphabet, to say that the gains that they're making in terms of the technology, the generative AI models, has really slowed dramatically. I mean, I think even Mark Andreessen went so far as to say we've literally hit a wall. That they're not really making much progress at all. It's why we haven't seen the latest version of GPT come out from OpenAI. There's not enough progress there to put something out that is significantly better than what's out right now. And people like Gary Marcus have pointed this out for a long time, that the fundamental problems, the hallucinations and things, are not going to be resolved by building bigger models with more expensive chips from NVIDIA is not going to solve the problem.
Well,
so I think the fact that the performance of these models is hitting a wall, and we don't have that killer app. There isn't a killer app out there that everybody has said, "Oh my God, this is going to revolutionize the world." It's still kind of out there on the horizon. That maybe at some point we'll figure out something that will be as revolutionary as the internet was, or something along those lines. And so I think the fact that there isn't that killer app, the costs are literally growing exponentially, right? They've said, the ChatGPT one cost, $100 million to make. Two cost, GPT-2 cost, 10 billion, GPT-3, 50 billion. We're getting to like hundreds of billions, to design these and program these new models. And you cannot keep spending, exponentially more money like that without any possible return on investment, down the road. So I think we are hitting a point in time right now where we're going to start seeing some rationalization of the spending. And that's a huge problem, because right now the estimates are for NVIDIA to continue growing to the moon. And that's even before you factor in like things like Amazon, who have just released a new chip, that Apple's decided they're going to use instead of NVIDIA chips, and other companies are finding that Anthropic is another one that made a deal with Amazon to say, hey, we're going to program all of our new models just on Amazon chips. So
Wait,
there are a
Amazon's
lot of
making
things going
hardware?
on in the space. I think the thing that I would just point out is the growth rates that we've seen over the last year or two are totally unsustainable, and the overbuilding of the overcapacity that we're seeing created right now could become a real problem, just like we saw with the build out of fiber optic networks and the backbone of the internet back in the late 1990s. Is it was completely overbuilt, and only 10% of everything that was built was actually being used. And that created a huge problem, lots of bankruptcies during the dot-com bust. And it took time for all of that excess capacity to be kind of taken up. And I think we might be facing kind of a similar situation with the generative AI space in the next couple of years.
Wait, did you just say that Amazon is making hardware now? So they're not just doing like cloud computing and trying to build data centers. They're committed to what, 150 billion in capital expenditure. A lot of it's going to be for these next generation data centers for their cloud computing and artificial intelligence. They're also building hardware now too.
They're building their own chips, yes, that compete directly with NVIDIA. And supposedly they say that their chips perform just as well as NVIDIA's, flagship chip at, half the cost. And which is why companies like Anthropic and Apple have decided to say, hey, let's see if we can run our models on these chips and save, a ton of money. And it's not just Amazon. AMD's designing a chip that they believe, or I think releasing a chip that they believe can compete. The thing that NVIDIA was so good at was at their chips, and not just their chips, but the software used to kind of run them, was so good at building these large language models that everybody needed NVIDIA chips and NVIDIA technology to design these models. Well, now that these models are hitting a wall in terms of their performance, maybe we don't need the NVIDIA chips to build bigger and better models. Maybe what we need to do is just find less expensive chips to run the existing models. And I think that's a potentially, something that's going on right now with a lot of these companies. Like I said, Apple's already made that decision to say, when we are actually, our models are actually being used by our users. We're not going to run that infrastructure on NVIDIA chips. We're running it on Amazon's new chips. And so if it's good enough for Apple, it's probably, and Anthropic, which is OpenAI's biggest competitor, then it's probably good enough for everybody. So, this is another issue that's facing the space right now. And I think it's potentially a downside risk for, the earnings growth and revenue growth and these types of things for the space over the next few quarters.
It makes perfect sense, though. I mean, capitalism is naturally deflationary. So with the competition, with the new technology, the higher profit margins, it makes sense that it's going to attract competitors who are going to offer a similar product, maybe at a lot less a lot lower price point to try to compete and gain market share. So overall, that benefits what the consumers of the technology, the people who are adopting it or upgrading in the upgrade cycle, rather than just the company at the top. So they'll be lead market leaders for a while, but then all the competitors are going to come and erode those profit margins eventually.
Absolutely. And I would just point out too that Apple's, AI, their first, foray into AI, in the models that they built themselves, they used all of just Google chips. So Alphabet's building its own chips to design its own large language models. And so, all these companies have decided, look, it's not in anybody's interest for NVIDIA to have a monopoly on AI, on the backbone of AI. So, Alphabet's chips, Amazon's chips, AMD's chips, they all have kind of designed chips now that are possibly way more efficient and cost effective than NVIDIA's at running the models. Maybe not, programming the models in the first place, but at least in running them, and that, in terms of the inference and things that they're used for. So yes, and when you look at something like OpenAI, which is just paying Microsoft, to provide the infrastructure for them to build their models, no company can afford to lose $5 billion a year indefinitely, right? And we saw that with WeWork, and unless OpenAI figures out a way to massively grow revenue or to massively cut their costs, they run the risk of becoming kind of the WeWork of the AI space. And so, I think these are the types of questions that the market's going to be asking over the next year, because this is where we're at with the evolution of generative AI. And as I said, it's very, very similar to what we saw during the internet, right? The internet bubble was built on the new technology of the internet and all the exciting things that it enabled, the new products and whatever. But there was a gap between the hype and the reality. The reality of using the internet was cool, but there really weren't a lot of ways to generate tons of revenue early on. And it took a long time to kind of build those business models that were sustainable business models around kind of the internet. Amazon stock price went down 90% plus during the dot-com bust. And so in that gap, where hype, takes that long to kind of meet the reality. And I think that it's very obvious, this is where we're at in AI, that all these kind of promises that AI is going to revolutionize the world, they're way down the road. And the fact that they're not going to be here tomorrow is a big problem for a lot of these asset prices that have discounted it arriving at any time, literally, arriving, artificial general intelligence, right? Computers that are smarter than humans,
Well,
is literally what's priced into some of these companies right now. And it's nowhere, near on the horizon.
and I also see an infrastructure and electricity usage problem too with all these things. Once all the land is acquired and the new next generation data centers are built, we just saw Elon Musk with XAI. He just had a data center, the Colossus one, built in 120 days. Absolutely insane. Each one, the hyperscaling racks is 3,000 pounds. Like, there's video of this. It's absolutely nuts. The amount of copper, the amount of materials, the amount of power, just to cool off these hyperscaling racks, all the GPU processors. And then the other one here is, just because a company is a market leader doesn't mean they're going to be a market leader 10 years from now. Look at Intel right now, Jesse. Intel missed badly. They whiffed on what the microprocessors, the chips in smartphones. They were not one of the market leaders for that, so they missed badly on that. And now they've invested heavily in CPUs, and they're stuck to Moore's law with getting down to the nano to the amount of transistors on the microprocessor. But now Nvidia and the other companies are doing it with GPUs, not CPUs. So Intel is an example of a company that was a market leader, and now the company's in trouble 20 years later.
Well, and I would just point out too that Intel was for investors. Intel was a wonderful business to be invested in. While Andy Grove, one of the founders, was there from the beginning and ran the company until 2000. While he was an owner operator, right, he had essentially all of his net worth invested in the company. And when he retired and started selling all of his stock in 2000, right, and retired from the company, that was the time to sell Intel. And you look back at Intel, and it's still far below the price peak that it hit in 2000. It's had negative return for 24 years. That to me is kind of tells you that, yeah, I want to invest in companies where there's a very strong, passionate owner operator whose interests are aligned with mine. And when that owner operator decides it's time to sell all their stock and get out, that's a very key thing to pay attention to. And the fact that Jensen Huang and his fellow board members and people at NVIDIA have been selling so heavily this year, it gives me, adds to my concerns, that I mentioned before about the sustainability of the company's growth.
Well, they've also talked about that they're going to have to co-invest, and OpenAI, didn't they switch to for profit over the summer? So they went from a non-profit, and the people that were funding them said you have to switch to for profit over the summer, because they even talked that they have to co-invest with the big technology companies into these data centers. So basically, then you're going to see Intel, OpenAI, and the other big technology companies we talked about have to invest into these data centers with no guaranteed profits. Are going to have to build out the infrastructure, like you said, which is very, very risky, similar to what the last huge capital expenditure cycle for building out the fiber optic cables and the high speed internet from a couple decades ago.
Yeah, and I think the other thing that I would point out is, the data centers themselves, are going to have value for, and I think this is why the companies feel okay with building out, such massive amounts is that, they'll be able to sell cloud services and all these kinds of things and utilize them, even if they're not using them to design new large language models and these types of things. But one of the things I think that we're seeing in the AI space right now is the fact that some of the most efficient products that they're coming up with are much, much smaller models, right? A lot of like, ChatGPT, right, is built on as much data as they can throw into the thing, like literally the entire internet, all of the every written word in history. Let's, give it as much data as possible and let it crunch, predict what, when you ask it a question, it'll have as much background to accurately predict what it thinks, you're looking for. That's how these models work. But what's working for customers is nobody needs a model that huge, right? Nobody really needs, if you're just
Well,
trying to,
or they won't pay. Adobe said, sorry to interrupt you, Adobe
yeah, yeah.
has this amazing artificial intelligence software, right, for graphic designers, but they said customers won't pay any additional funds for it.
Right. Yeah, yeah, absolutely. This is why Microsoft is having such a hard time selling Copilot. Is it just, people are like, wait, this is kind of a nice little feature, but it's not worth $30 a month. So
They have
but
to change
what
the business model. So they have to get people, they have to throw it into something else to get people to cover the costs for the software upgrades then.
exactly. So it's not generating revenue, but where customers are potentially finding more value is let's build a much, much smaller, more efficient model that's just based on our own data, right? We don't have to build this huge model that costs $100 billion to train the LLM. We can just use our own in-house data and train our own model that costs a tiny, tiny, tiny fraction of what these huge models cost to train, and it will be way more efficient because it's just based on our own unique data set. So I think this is another one of the examples of where they are finding value is in a much smaller scale and a much lower cost area of this market, which is not nearly going to generate the type of revenue to justify the cost of these huge models.
And I'm not a software expert, Jesse. I don't know about you, so I can't tell you which software company is going to win all this. There's gains from quantum computing too, supposedly Google in the last couple of weeks. In addition to this, the gains in computing power. So Google's having innovations there too. But in terms, I look at all these data center build out, the infrastructure. I see demand for copper going up. I see demand for conventional energy like natural gas, which is cleaner burning. I see demand for nuclear power. So the infrastructure companies, electrical utilities, uranium, nuclear power, copper, I see basically much higher floors for demand going forward, especially if these other countries like European Union, Japan, China, India also want these data centers as well.
Yeah, absolutely. And I think, The infrastructure is probably, I think that's what Wall Street's kind of coming around to the idea that, okay, we don't know. I mean, this has been a classic way to trade a bubble, is right. I don't know who's going to strike gold, but I know that I can invest in the guys who are, making the picks and the shovels. And until now, it's been Nvidia who's been the most efficient way to invest in this AI boom, because they're selling the picks and shovels to the guys who are looking for gold. But I would argue that the picks and shovels going forward are going to be those infrastructure companies and natural, providers of energy. And natural gas is going to be one of the most available and effective ways to kind of to generate energy to meet the demand. I mean, we're seeing a growth in demand for energy like we haven't seen in at least 50 years, if not longer. And so, yeah, there's the play on. I mean, I'm generally bullish on real assets, anyways, commodities and things. But I do think there is Wall Street is coming around to this idea that there is a play here that if the build out of these things is sustainable, and I think that's an open question, right? We might get to a point over the next year, maybe even, where a lot of these companies realize, okay, wait, we need to really scale back the build out of this stuff because the demand is just not there. That's a real possibility and a potential risk to these things. But if it is sustainable, then it is going to be very, very bullish for commodities of all types.
Well, even if the data centers aren't built here in the United States or they're delayed, I still think for natural gas that with the Republican controlled Congress and Trump, you're going to see more acceleration of building out natural gas pipelines to the refineries and the liquefied natural gas export facilities in the Gulf of Mexico area in Texas and Louisiana. So I think you're going to see an acceleration at least for 4 years, probably, unless the congressional elections flip things. You're going to see probably discounted, maybe energy policy where there's discounted debt to go and build these liquefied natural gas export facilities, some of which were already planned, but I think it's going to be fast tracked. So I think you're going to see the U.S. become like the clear number one liquefied natural gas exporter in the next 4 or 5 years.
Well, and there's just a huge arbitrage between European prices for natural gas and US prices, right? There's a huge opportunity there. And so, yeah, if you just kind of cut some of that red tape that makes that, taking advantage of that arbitrage possible, then yeah, there's a very significant potential for, to export natural gas to Europe and other places where it's not nearly as readily available as it is here. And that is a huge opportunity for natural gas producers because it probably means, the natural gas price globally meets somewhere in the middle, where gas prices rise here and come down in places like Europe.
So for which sectors or industries you think will benefit from a Republican controlled Congress, Trump in the White House? Natural gas would be at the top of the list, or do you see other industries that would be better than potentially the natural gas, liquefied natural gas exporters?
To me, it's not even really a political thing. I think it comes back to the dollar, and the trajectory of the dollar. I think would be the same regardless of who's in the White House. That like literally, there's a bipartisan, unspoken agreement to ignore the fiscal problem. And that means the deficit's going to continue to widen, going to be bearish for the dollar. In a dollar bear market, this is something I didn't really point out in the beginning, but it's not a coincidence that the dollar, secular trends, the bull market to bear market coincide with bull markets in the stock market, right? The dollar had a very strong rally into the early 2000s, right alongside the stock market, S&P 500. Stock market peaked and rolled over in late 2000, 2001. The dollar rolled over, kind of made another high, I think, in 2002, rolled over into major bear market. And that dollar bear market coincided with a lost decade for stocks. It's, like I said, back in 2012, we started a new dollar bull market, and the post GFC period for the stock market has been, even better than it has been for the dollar. So I think if we are in a dollar topping process longer term, that tells you kind of what you want to own going forward. And unless somebody's going to make a major change in the the fiscal situation, and you can't really do that without some dollar bearish. Right. I mean, if you were to cut spending dramatically, you're going to cause a very painful recession, which would probably be bearish for the dollar. Anyways, but if we're in entering a secular dollar bear market, you're going to want to avoid stocks and bonds, and you're going to want to invest in real assets, and that's commodities and precious metals and these types of things. Just like we saw from that 2002 to 2011-12 timeframe, it was just a wonderful time to turn your focus from financial assets to oil and gas and gold, et cetera. And I think that's where we are now, is a very similar time as where we were 20 years ago. So yes, all of these other things are important. The reshoring of production, of manufacturing, right? That's another bipartisan thing that, Joe Biden kind of created all these infrastructure policies, kind of boost reshoring of production. Trump wants the exact same thing. So it kind of, regardless of who's in the White House, we have these policies that are very, very bullish for real assets and probably dollar bearish. And so I think that kind of is a big under the surface macro theme to pay close attention to.
Now, I know you cover insider buying a lot for your newsletter. Is there actually a large amount of net insider buying for a lot of oil and natural gas producers in the US and Canada and gold miners? Because those companies, there seems to be a good amount of, for the larger and medium-sized ones, a good amount of free cash flow still, even though the oil price is relatively weak. And then for the gold companies, I mean, a company like Agnico Eagle, they have record amounts of cash flow right now. Their costs are not out of control, and yet the stock is very, very out of favor. The valuations are really cheap, and they have two of the best, lowest cost, long life mines on the planet.
Yeah, I mean, I've written over the last several months, I've written a few pieces, a few specific trade ideas on energy stocks where billionaire investors are buying heavily. If you look at Buffett, the only thing he's been buying over the last, I mean, in significant size over the last, few years has been Occidental Petroleum. He's built that up. You look at the energy sector in the S&P 500, it's about 2.5%, and it's closer to 20% of Buffett's portfolio. So it tells you, if you're looking to outperform the index, I mean, Buffett's making a huge bet on overweighting the energy sector, in his portfolio in the years to come. I don't know if he's ever done anything that dramatic in the past. I haven't looked that up, but it's important that Carlos Slim. I think we've talked about this before. He's in the market buying PBF energy stock almost every day. A big refiner. Jerry Jones, right, owner of the Dallas Cowboys, has been buying tons of natural gas stock, where he is the largest shareholder, Comstock Resources. I mean, like big buys. And it's really kind of the only, I mean, there's one other one I would point out, which is Wes Edens, who's the founder of Fortress Investment Group, owner of the Milwaukee Bucks, right? So these guys are, massively wealthy, right? Owner of the Dallas Cowboys, owner of the Milwaukee Bucks. Buying New Fortress Energy stock, which is one of these companies that is working to export liquefied natural gas to Europe, and they already have a couple of ships up and running that are doing it. So it's really kind of, to me, the only area of interest that I've seen over the last year are these multi-billionaires who are committing significant amounts of capital to these undervalued energy stocks.
And I think Druckenmiller and David Einhorn have been dipping their toes into gold miners or oil and natural gas companies. I think David Einhorn and Druckenmiller even bought some coal companies in the last 12 months. So they are looking at energy. To add to your points there, I think there's been over $250 billion in mergers and acquisitions. So maybe there's not massive amounts of net insider buying per se by the insiders, but they are seeing the cheap cash flows in the assets, and the oil and natural gas companies are going and buying other companies because they want to replace reserves. They see the discounted cash flows is relatively cheap, and they're taking a longer term picture that the energy prices will be headed higher, especially with that demand driver there for the technology cycle, the investing, if that plays out.
Yeah. And I would just say, You look at the greatest investor of all time, and he's sold down his Apple position massively and built up his energy holdings. I mean, to me, that's another clear thing you can kind of infer that he wants to be underweighted technology and overweighted energy. You can look at him just like I was talking about those other equity portfolio managers. You either have to kind of closely align yourself with the index to not underperform, or you're like Buffett, where you're willing to make big contrarian bets, and that's what he's doing today.
Are you a believer in this small cap rally, or do you think it's a bear market rally that the small caps have a lot of negative factors ahead of them? What with the ones that cater to a consumer with too much inflation and high interest credit card debt? Do you think that this small cap rally is sustainable?
I think generally it's not. I think generally the small cap indexes are overvalued, are significantly overvalued. I don't want to own small cap in a passive way. That said, where I am finding interesting insider buying outside of the energy sector, it's typically in, small cap stocks that are outside the purview of the indexes and have, kind of been beaten down and there's zero interest by Wall Street, there's zero interest by retail investors, and the stocks, individual stocks get significantly undervalued. So I do think that's probably the best area of opportunity for active investors looking for individual opportunities. But generally, I don't want to own the index because there are tons of unprofitable companies, and the valuations of the group are probably too high. I think you could say that about the stock market generally, that it's difficult to say there's really any segment of the market that's undervalued when every segment of the market, as my friend John Hussman has pointed out, even the cheapest decile of the stock market trades at its highest valuation in history. So there really isn't a segment of the market that looks uniquely, like it's providing an interesting opportunity. I think you have to kind of look below the indexes to individual stocks.
Well, in terms of industries, what's cheap and hated valuations, I think the oil companies, because I think they make up over 15% of the total profits of the S&P 500, and that their market cap, like you said, is only about 2%. So there's a huge mismatch there. The market is drastically underweight these profitable oil and natural gas companies overall. So I think there's potential mean reversion there, especially if their profits are going to hold up at those levels or we have higher energy prices. The gold companies, as in general with the market cap, they're not large enough to be like considered a separate segment. But I mean, like some of these gold companies, Agnico Eagle, their costs are what's below $1,500 an ounce. So they have over $1,000 an ounce of free cash flow. The market just doesn't care. But these companies that are literally, probably going to be raising dividends, they have like really high grade, low cost mines. They're minting free cash flow. The market just doesn't care about these companies right now.
Yeah, I mean, there's too many shiny playthings to distract traders from the gold miners right now. I will say though that I think that the miners do look really cheap relative to the gold price. I mean, rarely have we seen gold do what it's done over the last 12 months, and the miners, really not, even lift their heads off the mat. Very much. I mean, they've kind of continued to trade sideways even as the gold price has screamed higher over the last 14, 15 months. And so I do think we're probably in a period of consolidation for the gold price over the next 6 to 12 months, maybe even longer. It's had a terrific run, and that's how gold trades. Is it runs and then it pauses, even in gold bull markets. And I think we're probably in a consolidation phase now for gold for the foreseeable future. That doesn't mean that the gold miners can't perform. In fact, I think they probably have some serious catching up to do to the upside. But it might take, things like Bitcoin reversing lower and kind of, deterring, all the traders looking for the hot thing to, kind of inspire them to look elsewhere before the miners are really ready to move.
Or you're going to see consolidation in space. So you're going to see the larger companies like an Agnico Eagle that has really high profit margins and free cash flow. They're going to say, well, these assets are so dirt cheap. We're going to go buy more stuff. The market is not recognizing this value. We're going to go buy assets for pennies on the dollar, and we're going to have a better company a couple of years from now. I think you're going to see more of that now if gold prices stay, in that trading range, like you said. The companies that have that free cash flow now, they're going to go and start buying stuff.
I mean, absolutely. That's what's kind of wild about, I think the energy stocks and the gold miners right now is at, even in current price. I mean, oil price is in the low end of its range over the last, few years, but companies are still terrifically profitable even at, $70 a barrel oil.
Well, Exxon
And
is, yeah, Exxon and Chevron are, yeah.
yeah, and so I think that the fact that and I mean the miners with 2,600 gold, most of them are printing money. And like you said, a lot of them have a really low cost basis, and if the gold price doesn't go down a ton, then yeah, just the free cash flow they're generating is pretty wild. And eventually, as Ben Graham famously said, the voting machine gives way to the weighing machine, and the market will be forced to weigh the terrific profits that the companies will be generating, and that will be reflected in the stock prices. But like I said, a lot of what I look at are the relative performance, right? And so to me, the miners have typically when you see the gold price do what it's done, the gold miners would be some of the best stocks in the market, right? They've obviously been some of the worst stocks in the market this year, even as the gold price has gone to the moon. That's a very unusual situation. So, but like I said, that can rectify itself one of two ways, right? Either the gold stocks, outperforming the S&P 500 to the upside, or vice versa, the S&P 500 falling while the gold stocks show good relative strength in that type of environment. And so I think that it will be very helpful to the gold miners if there was a significant correction in a lot of these really hot stocks, things like Bitcoin and MicroStrategy and all the things that have, like I said, garnered all the interest by the hot money in the market right now.
Are you seeing any larger generalist fund managers buying gold stocks, or was it really only Stanley Druckenmiller earlier this year that there's just not much interest so far?
I don't see much interest. Generally, it's not. Honestly, it's not something I track very closely, other than a handful of people like Druckenmiller and Buffett. Um, that said, I trying to mimic somebody like Druckenmiller. Druckenmiller is a technical trader, just like Paul Tudor Jones is another guy I watch. And these guys are basically technicians. They're looking at the charts, and and they lead kind of the rest of the market because they kind of can analyze through studying the charts whether something is going to start to show that type of relative strength and break out to the upside. So when you start to see that those signs of technical positivity, that's when you're going to attract that type of capital, the Druckenmiller, Paul Tudor Jones types of traders that are looking for signs, that technical signs, just in the chart, that they look like they're going to break out to the upside. And I think that's what will not only get those guys interested, but will get traders and the hot money on board as well.
And Paul Tudor Jones had some very interesting comments in the last couple of weeks about bonds. Do you agree that bonds are in a long-term secular bear market still, as these other central banks have already started to cut interest rates, and it looks like the Fed will continue to cut interest rates? I don't know if it's going to be every couple months, but they're in an interest rate cutting cycle.
Yeah, I do think that after 2020, 2021, when interest rates bottomed, we've seen a major reversal in the bond market. That bond bull market is over. That's when the bond bull market ended. With a 10-year yield under 1%, and it's generally headed higher. I think the reason I don't want to be short long-term bonds is, the Fed does have that QE type of tool in its toolbox. Jerome Powell references it pretty much every time he is interviewed, is they have the ability to reverse quantitative tightening and start buying bonds again. And they're no doubt absolutely do that if we were to see some type of a Liz Truss type moment where the bond vigilantes decide, okay, no more are we going to, buy bonds at these yields when there's no hope of them getting paid back without significant money printing. And I think we're already at that stage now where I think that's obvious that the only way the money's going to get paid back is by money printing. Now the bond vigilantes have not kind of you put their foots down yet, and at some point they probably will. I think, as we've talked about in the past. Bill Dudley, former head of the New York Fed, has suggested it's a possibility. Druckenmiller, Paul Tudor Jones, all these guys are talking about it. Buffett is staying away from the long end. All the smart money in the room is saying stay away from the long end of the bond market. So they're all kind of positioned for that type of an event. But if it were to happen, I think the Fed would absolutely, step in pretty quickly and say, okay, we're not going to let interest rates go to the moon. We're going to have to cap yields at some point, and that, that's probably where you get the next, up leg for gold, right? Is when you get closer to that type of a thing. I don't know when that happens, and it could be next month, it could be a year, 3 years from now, but that's probably the type of catalyst that gold bulls would be drooling over.
It also looks like the bond vigilantes are more focused on like a currency crisis. So the government bonds and the debt monetization, the central bank panicking, they're more focused on a currency problem than where the currency gets rapidly devalued, the central bank starts to monetize debt. And that happened earlier this year in Japan. It looks like it's happening potentially now in Korea with the Korean central bank announcing basically almost unlimited or unlimited emergency liquidity measures. So that would probably attract the bond vigilantes who would attack the currency then against the dollar. So they're more focused, I think, on other government bond markets and other currencies right now than the dollar.
Yeah, it could be, right. I mean, I think that, these are crisis type of events, and they usually have a catalyst, right? It wasn't, like the UK fiscal situation, all of a sudden was going to, dramatically change. It was just, a poorly worded, budget proposal that, created a crisis in the bond market.
Are you
And
talking about
who
the
knows?
70s? Sorry to interrupt you. Are you talking about the UK
And
where the British
I'm talking
pound?
about the Liz Truss moment.
Okay. Not the
Where
Soros one where he broke the Bank of England with the 70s.
no. I'm just talking about what we saw this not too long ago in the UK gilts market. And who knows what the catalyst could be? It could be the Trump administration pushing through an extension of the tax cuts without any kind of commensurate spending cuts on the other side to pay for them. Who knows what it
Or
could be?
or he puts
But
$100
there's
tariff on
probably
a
going to be
trade
a
partner.
catalyst.
Or he puts Jesse, or he threatens to put 100% tariff on a trade partner, and then we're back to what 1930s beggar thy neighbor, where each country then sends out press releases threatening tariffs and other stuff on each other.
Yeah, I mean, I thought it was important that China announced, right after Trump said, threatened to put tariffs on everything. China said, well, we're not going to ship any more rare earth metals to the United States, right? Like
Yeah.
you start getting the tit for tat stuff, and a lot of those rare earth metals that they're talking about are absolutely necessary for producing, defense weapons and things. And so it's like, yeah, you risk escalating those types of scenarios. But it's all kind of potential catalyst for those types of things. I obviously don't know what it could be, but there probably would be some type of a catalyst like that that would send yields higher to before you get some type of a Fed intervention and things.
I agree. I think we're going to see more bond market volatility in other countries' bond markets and currency market volatility in those other foreign stock markets with these press releases going back and forth threatening. I think Trump is trying to renegotiate some of these trade deals, but it's going to be a mess along the way if he while the negotiations are done in public, because he's making all these threats, and then you have the other country then starting to make threats, and the market's like, this is uncertainty, I'm out. They're cashing out of all their long positions then in the stock market or bond market in these foreign countries.
Yeah, I mean it's been interesting to see how much the stock market has effectively ignored so far. At some point, the stock market's not going to ignore it. I mean, the bond market didn't really ignore it after the election, right? We saw the long end of the yield curve, spike up again, and then the announcement of Scott Bessent, kind of calmed things down again. And so, there's just no knowing with Trump how much of it is bluster and how much of it is actually going to be backed up with actual action. And I think that's probably what the markets are reacting to is it's easy to kind of threaten these things, but actually what's going to actually be implemented. And once we start seeing that, I think that might be where markets start to react a bit more.
And did you see a chart of the gold price during Trump's first term, the first 4 years? Because I think he was still running around $1 trillion average budget deficits each of the first 4 years in his first term there. So base case, I mean, we're looking at least $1 trillion budget deficits, probably more than that, which when you add in the interest payments on the national debt, because I don't see interest rates going back down towards zero. But the interest payments for 15 years, Jesse, they were only, despite all the debt that was grown, the government budget deficits, it was only about $300 billion a year. Do you see a scenario where we're going to get back down to only $300 billion per year in interest payments on the national debt?
No, I mean it's right. I shouldn't say no because we could. I think we're likely headed for some type of financial repression at some point in the future, which would be the Fed capping interest rates in order to make that interest rate burden more bearable for the federal government. I think we're already in an era of fiscal dominance where the needs of the Treasury, the needs of the federal government kind of dominate monetary policy. I think that's probably why, we're seeing the Fed cutting interest rates right now is because there's really no other reason for them to be cutting other than the fact that the interest on the debt could become a real problem, right? I mean, when you have the type of animal spirits that we see in the markets today, and financial conditions, being essentially as loose as they ever get, there's no reason to be cutting interest rates into that, yet they're doing it, and that tells me that it's really just the needs of the Treasury that's driving things, and that makes it pretty clear to me that if the interest on the debt ever became problematic, right, then we're going to see financial repression in this country. Again, we've seen it plenty of times in the past. James Grant, Grant's Trade Observer, has kind of chronicled the history of this better than anybody I've read. But it's not unusual at all to say, hey, look, it's your patriotic duty to buy bonds that yield less than the rate of inflation in order to kind of support what the government needs. We've done it during wartime. And you could argue that, with what's going on around the world, we can potentially be facing another, wartime situation where the needs of the government are more important than the Fed's desire to move interest rates to a higher level for whatever reason. So I think we're likely the potential for financial repression in the future, I think, is elevated.
Yeah, I totally agree. And it looks like a lot of other countries and central banks are going to do something similar where they start cutting interest rates in an interest rate cutting cycle. They start monetizing debt and they want the real inflation rate and nominal GDP above what the yields on the government bonds. So the debt gets inflated away, what in real terms?
Yeah. Yeah. I mean, I think that's kind of really the only way out of the situation that they've been created. And history suggests it is the only way. So, that's what where we're likely headed.
Yeah, similar to the 1940s. I think Lynn Alden has also talked about this. Besides James Grant of Grant's Interest Rate Observer, she's said this period is more going to be like the 1940s rather than the 1970s stagflation, which was what financial repression and yield curve control, like you described.
Yeah.
Well, Jesse, I really enjoyed our discussion today. I want to thank you so much for your time. Are you doing the podcast again with the super investors? Are you interviewing a lot of investors for your podcast behind the paywall, or just focusing on your newsletter?
I've been on hiatus from the podcast for a little over a year, but I'm getting ready to bring it back. There's too many interesting people to talk to about these very issues that we were just discussing, Jason. So I'm getting ready to bring it back.
Excellent. That was really good. I really enjoyed that in the past.
Well, yeah, I mean, I like it's one of the most fun things for me to do is be able to do these kind of discussions, conversations, and as I said, I mean, there's a ton of people that I've over the last year that I've kind of built up and want to talk to on all that are way smarter than me about a lot of these issues. So, yeah, you can expect super investors in the art of worldly wisdom to be back before long.